Partnered by Times Influence.
In our mission to help every Indian rise with India, today we want to address a very specific category, the policemen. Well, we are grateful and thankful for them for our security, but today we want to make sure that how their financial security is taken care of. What is the importance of inflation? What is the power of compounding? How each and every Indian policeman who have been serving the nation, who have been serving Indians, how can we really take care of their financial future? And in our endeavor to achieve that, we are glad and we are very delighted to join hands with Aditya Birla Mutual Funds. Bala, CEO of Aditya Birla AMC, now joins me to take this mission forward. Whereas Jan Nivesh is an umbrella theme which AMFI and ET now is committed to take forward. I guess when it comes to specifics, one category which we know about, one service segment which we all rely on for our safety, sometimes they take care of our safety, but we don't take care of their financial safety.
Yeah, exactly. I think if you look at the way the mutual funds have been increasing the penetration, from focusing on big cities, in the last few years we started focusing on smaller cities, and that of course reflects on the industry number, which is coming largely from B15 and B30. So there has been an increased level of penetration that industry has been trying to do. I think the initiative that is being undertaken under the AMFI umbrella definitely actually serves the purpose of getting more and more customers on board to the mutual funds from the longer term wealth creation point of view. At the same time, there are different market segment as well as customer segment we focus. Having done that, we at Aditya Birla Sun Life Mutual Fund, we have undertaken few special initiatives to drive the investments for coming from the army set of people, and we have done many such events only to educate army and naval officers. At the end of the day, they actually got the country. At the same time, they need to also protect their retirement planning, or maybe create wealth actually themselves by way of investing in small amount in a monthly SIP basis. The same way, these police Nivesh, what you mentioned about, is also a segment, as you rightly put it, they take care of the country needs. They are of course ensuring the safety of every city in which they are posted. At the same time, they need to also take care of their own longer term savings needs, which could come in handy for taking care of their children education, or buying their house, or about marriages and so on and so forth. And that's why I think we felt that this is segment also need to be addressed. I think the mutual fund is, while it generally is generally the investment is coming from the people who are considered as rich, but mutual fund also can actually serve the people at large by making them invest in about as low as about 1,000 rupees per month, and then keep building their portfolio. And that's why I think Aditya Birla Sun Life Mutual Funds remains committed in spreading the awareness among every segment of the market. And the one such initiative that we are currently doing with you is on the police Nivesh.
What is your understanding of the profile of someone who is associated with the police department or with the Navy department or with the army department? How exactly do you think their savings are? Do they understand equity? Do they understand mutual funds at all, or they are just parking the money in FDs and real estate?
I think clearly, if you look at historically, predominantly if you look at the history basis, if you look at, so one of the permanent saving they get is their own provident fund savings, and second is the gratuity savings, and third is retirement saving, which again comes as part of their pension plan under which they are all covered under the Government of India schemes. But whatever the money is left out, most of the time they either go and park it in either fixed deposit, that do not have fixed deposits of just as a bank, probably they will go and park it in Ponzi schemes and somewhere expecting that it will get a higher rate of return. I think the investing in actually for wealth creations, I would assume very small proportion of the, though I don't know the exact number, but I think small proportion of the people must be investing in the mutual fund schemes for wealth creation. I think one of the area which I would assume that each one of them have to take care is the longer run. Definitely the mutual fund schemes, especially on equity, does generate wealth, and the only the way they can also participate in the India's rise and the growth in the economy that is coming in. They can benefit only by investing a small amount in every month basis, without looking at what the return they will be generating, but stay invested for long term. That's the way I think they can actually make their investment shift from whatever the traditional investment they are making towards this kind of investment.
So according to you, there is lack of awareness, or this is purely risk management which is keeping them away?
I think it's a lack of awareness. Risk management, I think, I don't think they would have gone to the extent that analyzing this, plus they would not have time, even time for that matter. Definitely the lack of awareness, and then putting a small amount every month absolutely is not a difficult job for anybody. But at the same time, if you make them realize that the importance of a very small saving every month and what kind of benefit that can accrue to them by investing in some of the funds of the mutual fund schemes can benefit them actually in the long run. That I think awareness is missing. Second is, for most of them, wealth creation means what comes to the mind actually is buy real estate assets, and that's why we create the land ownership in general for most of the people is pretty. I would say it's more of tradition, but not necessarily they create wealth, but they have the feeling of that they have the land, and that's why most of the people actually create the wealth. But another way to actually to plan the wealth creation is through the mutual fund. That awareness is not there. And the third, of course, is about every individuals, whether it is police force or any working population at the bottom of the pyramid, need to plan for their longer term needs. And the longer term needs, most of the people don't estimate what the kind of needs they will have. For those kind of needs, what they need to save, and through the organized channels such as mutual fund, and that generally doesn't occur to them.
Why do you think two simple principles of tax saving and inflation are misunderstood? Even power of compounding for that matter. Three very basic principles you would imagine that we learn in primary school. Inflation is Mehungai, which is constant in India. Tax saving is something which you can do immediately, and this is that season. And third, of course, is power of compounding, that the longer you keep, your money multiplies automatically.
Exactly. I think the principle of investing, as you rightly put it, I think power of compounding is the primary driver in the long run. And what is also driving that is actually the inflation is eats into your money. So most of the people don't realize that not managing your financial planning right, many times you end up losing your money because the inflation every year keeps rising. At the end of the day, inflation nothing but a cost of the living going up, and the cost of goods prices going up, cost of service going up, and therefore one need to also keep pace with that rise by way of investing actually into the assets that can create them wealth. So that's why I think the power of compounding comes in. And most of the time there is a lack of awareness in this aspect, the basic concept, but at the same time not paying attention to the one of the most important the element of savings is something I think is it's something everybody has to realize it. And having said that, I think if the investments are made to as a habit, see, I think there is one area where there is an element of good amount of habit that exists is paying your contribution towards PF and paying your premium towards your insurance policy. There is a habit set in. A similar way, a habit has to be set in form of investing in SIP. And finally, for every consumer, every salary earners, do not realize that by making some investments in tax saving instruments such as ELS schemes of mutual fund, equity linked saving schemes of mutual funds, they can save some kind of tax.
So ELS is better or PPF is better?
I think ELS is better. This is where I think the power of compounding is actually is real, and it comes in the long run. Gives a substantial benefit to the investors. Having said that, PF of course gives an element of safety, and PF is run by the government of India, and there is a fixed return that you get. It does not have because there is a fixed return, the power of compounding also is limited to only the extent of the return that is guaranteed. Whereas in the ELS schemes or mutual fund ELS schemes, there is absolutely no guaranteed return. One has to remember that. So there is a clear differential between these two. And power of compounding in the short run may not actually reflect the power of compounding that exists in PF. But the very fact that you go and invest in PPF for 15-year period, in a 15-year period, I think equity investing as a concept can give you a substantial benefit to the investors. Therefore, that waiting period itself gives you a power of compounding impact.
So just to keep it very simple for somebody who just wants to take a baby step, do you think ELSS should be the first no-brainer instrument? Because the minute you purchase an ELSS instrument, you may be getting a 3-year lock-in, but you also get a 30% tax saving, which means you are in the money from day one itself.
Exactly. I think one is, as I mentioned, that tax savings is also one of the planning every salary class has to have, and including the police force.
Should ELSS be the first one which every policeman should start with?
Exactly. ELSS it could be a one to start, for two reasons. One, it locks yourself for certain period, that itself make them get less worried. And second is making the investment continuously and realizes the schemes, given the fact that money manager stays invested for long period, the ability to generate higher alpha in the portfolio is also equally high. When I mean alpha in the sense about ability to generate return in the long run is far superior to any of the short term instruments.
Just like the mission statement of police is to protect and serve the country, take care of our safety. If you have to make a mission statement and pour in your experience and talk about a mission statement which will course the change of their financial life, how would you plan a quick, a quick list?
I think clearly protecting your future needs.
So first, buy insurance.
Yeah, protecting your future needs by your insurance. Investing for the future, for the purpose of say wealth creation, it should be another agenda that should have. These are the two concept I think should go hand in hand.
Can you just break that for us?
Investing in equity schemes of mutual funds in the form of monthly, keep aside some portion of the money.
It could be as low as 500.
It could be as low as 500 rupees. And assume this money you are spending it. Don't assume this money is being saved. The moment you go with the assumption that the money is being spent, but of course spent not in really buying an assets. In this case, I am buying a mutual fund unit. The moment you go with that concept, any money that is spent generally is no expectation that you will get back immediately.
What should be that percentage? How does one choose that? Because I commonly get this query. Should I save 5% of my income? Should I save 10% of my income? Because till the time you don't give a goal or a number to anybody, it's hard to put in that discipline. So what should be a very basic core mantra in terms of a percentage saving for an Indian saver, Indian policeman?
I think the large pool of working populations, which includes police force, one of course they have to take care of the monthly expenditure, and that's your first primary objective, to meet your household expenses, and that comes to you after deducting your PF investment. I think you have to have a formula such as the PF, where there is a 12.5% reduction, that deduction happens as your contribution. A similar kind of formula that you need to have on your basic income, minimum of 12.5%, I think you should keep towards an SIP. I think if you are able to build that as a concept, then your expenditure accordingly will manage it. Your household expenditure accordingly will actually manage it, because this goes an automatic deduction and you get less money in your hand, and within that less money that you get in your hand, one need to learn to manage your household expenditure.
So that's a great starting point, which is that keep 12.5% of your in-hand saving for SIP.
Exactly.
Okay, what should be the time frame? 3 years, 5 years, 15 years?
I think as long as his working life is going to be.
And in this case, there is predictability, because if you are with the police force, at least you are reasonably confident that you will have a regular monthly income. So you can actually plan your life. Unlike a private sector job or unlike a private sector representation which you and me have, the advantage with the police job is that you can fairly confident of a monthly income. So the SIP planning, I think, fits in very well.
Very well, correct. Second is, if somebody is at the age of 30, his retirement is going to happen at the age of 60. Essentially, he has about 30 years of working life he is going to have. Therefore, any SIP that one is doing has to think of the SIP for 30 years period.
So two categories of policemen: one, someone who just started and joined the service in his 20s, early 30s, and someone who's about to retire in next 2 years. Now, for someone only had 2 years of working life left and someone who has 25 years of working life left, how would you advise?
I think clearly somebody is at the age of, at the young age, I think the formula that is applied is about 100 minus your age should be the allocation towards equity. That is one. And second is, somebody at the age of 30 has got a 30 years of working life. Therefore, he has to actually choose the period as 30 years, not as 1 or 2 years. You should never look at, I made investments last year, what is the return that is coming? You should stop actually looking at the return and then keep this money for 30-year period. Somebody has got only 2 years to go from retirement. Definitely, he has to actually start getting every month some bit of pension income kind, equivalent of pension income, and whatever he will be getting from the government in the form of pension plan, he has to also get some bit of income that is coming to him on a month-on-month basis. Therefore, for him, he has to choose a mix of equity and more of debt. I think less of equity and more of debt, because fixed income will give him that predictability of return little higher than the predicted return that comes in equity. And of course, equity of course gives him on a 5-year and 10-year basis, it gives him help him actually creating more wealth. Therefore, you have to take the combination of these two, but predominantly those investments can be made actually in fixed income schemes, wherein he actually withdraw every month whatever the needs of him. So, this is called systematic withdrawal plan, as I mentioned about SIP, and there is also a withdrawal plan that exists in mutual funds, where you can fix your monthly minimum amount that you can withdraw, say 5,000 rupees or 10,000 rupees or 20,000 rupees, we can withdraw to the extent that you can withdraw. I normally advise people do not withdraw beyond the return that you can get either investing in any other fixed income instruments in the banking systems. If the banks gives you 8% on your on fixed deposits, when you invest the same money in mutual funds, you do not withdraw beyond 8%, you withdraw only to the extra 8%. The moment you do that, you do not end up having withdrawal excess of your return that you can generate. Therefore, capital remains preserved. At the same time, whatever the money that is earned more than 8%, that money still remains within your own account. Therefore, it also gives you a benefit in the long run.
Okay, the three most common goals which I think everyone has. One is to buy a house. Second is to save for child's education. Third is to make sure that your daughter or son is married. Do you think a 15-year SIP only in debt, no equity, can fulfill your needs?
Definitely yes. Definitely yes, because fixed income also at the end of the day does generate reasonably decent return. Of course, it's in line with what you will get normally from banks fixed deposit, except the volatility is high. And second is power of compounding is equally applicable in fixed income investment as well, except of course the real big power of compounding would come on the basis of the return gap between investing in fixed deposits, fixed income schemes, and the equity is quite large, and that power of compounding will have an impact in the long run. Therefore, if somebody come for 15 years, well, of course, you can choose a fixed income which we cannot say no, but at the same time he also has to remember the time period that he is choosing is such a long period, he has to have a good combination of equity schemes such as ELSS schemes or any other open-ended equity schemes along with the fixed income schemes.
So, if you have to summarize today's interaction, and this is very focused interaction for the police community, one would argue that look, the police community in India, they are not aware of how wonderful instruments are available in terms of tax planning and also portfolio planning. So, they should be A, aware of that, B, they should start by allocating about 12.5 to 15% of the total in hand into SIPs, and when they are saving, they should not worry about today, tomorrow, election, no election. They should have a minimum 5 to 10 year time frame.
Exactly.
And by doing simple things like starting a SIP, according to you, they can easily reach their basic financial goals.
Exactly. I think it's better to keep it simple.
What is the risk, Bala? If it was so simple, everybody would have been rich.
Which is of course I think not understanding that you have to give time for every investment that you are making, you have to give time for it to deliver. I think the bigger issue that we do have in every country, I would assume, is about you expect your fulfillment to happen in the short term. Fulfillment cannot happen in short term, fulfillment will always happen only in the long run. In any field that you take, fulfillment will happen only in the long run. That is equally applicable for mutual fund investing also. Therefore, the time that you are giving for your investment to pay off for you has to be the longer time period.
When we say long run, is it like passing the risk away? Is it like kicking the can down the road, because 15 years nobody is going to be holding anyone accountable? Or you genuinely believe that in 15 years wealth can be created?
I think for everything you have to give time. The risk is something will always be seen only after the risk arises, because you perceive on certain things this is the risk you may carry, and not necessarily that risk that you are assuming will happen actually at the time of you think actually. The risk at the time of you do not even think about the risk, suddenly it will occur, the risk will occur, and that will of course can be seen as if it's something which is unexpected, or it was should have been known before. I have seen in my own career in mutual fund industry, the risk never tells you and come. The market fall never tells you and come. It just comes as long as you are able to actually have the wherewithal. You are able to have the wherewithal to rather fathom those kind of volatility and hold your conviction that for longer term years will make money. It does gives you results. Maybe the expectations, as long as you keep it low, then your success ratio is high. If you keep expectation high, then the disappointment will also be equally high. So, it's all about the mindset and the expectations, and what we set ourselves as a target on return expectations. As long as you keep it very moderate, and as you generally people draw happiness and the comfort just putting money in savings account and FD, knowing very well it eats into your return in the form of an inflation eating into that, but people are generally happy. A similar kind of an approach that one should take while making investments in.
But is your money
fund.
safe in SIPs? That's a question which I have been asked. Who's giving you a guarantee that when you want the money it will come back? How can someone be sure?
So, I think clearly on the mutual fund, I think the beauty of mutual fund, that's why thanks to even SEBI as a regulator have brought in very high level of transparency. Every rupee that is collected, it's where it is invested is known to the investing public. It does not differentiate that investment portfolio is known to only to the person who have an access to the mutual fund as big investors. It is available to all the investors, right from the person who has put 100 rupees to as high as about say 100 crores. So, it does not differentiate, and all the 100 rupees of investment to the last pie is actually disclosed. And the third, which of course the beauty of mutual fund, there are many investors who come share the risk and also share the profit, and that's I think the beauty. Many times I think people generally get panicked, oh there is a mark to market loss is coming, the market has gone down, there is going to be a fall in NAV and so on and so forth. One has to remember the fact that that fall in NAV is shared by millions and millions of people who have put money, or lakhs and lakhs of people put the money. Therefore, the share is shared, that the fall is shared, therefore, the risk for you individually is less. At the same time, the big gain has come, the gain is also equally shared in the form of net asset value. So, I think that is the beauty. And third is in the history of mutual fund, even there is a time where the stock markets were closed for a period of say 1 or 2 days, I am talking about the early 90s, still mutual funds did pay all the redemption that they have met on time.
So, your money is safe.
The money is
it's a mark to market loss which comes because of market conditions.
Exactly.
Okay. So, ET now has a mission that we want Indians to rise with India. That seems to be the broader pitch which is also coming from your mutual fund. So, if we have to really make a mission statement where every Indians can rise with India, you think one should start coming out of the comfort of FDs and real estate and start betting on the Indian entrepreneurial spirit?
Then I would say don't come out of FDs fully, don't come out of real estate also fully. I need to have every asset class as part of your portfolio. At least if you don't have mutual funds, start the mutual funds immediately.
Don't be scared.
And don't be scared. Not necessarily you have to put all your money in mutual funds.
And if I say that what is a good day to start SIP, can I say it's today?
It is today. It's like now times. And one has to start investing and don't keep waiting for the market to come down to time your investment, and don't wait for somebody to come and give you a signal that is the time to invest.
So, time your goals, not the market.
Exactly.
Really appreciate your time. Thank you for partnering with us. We are very excited to this time take the cause of financial inclusion to a different community, and we are very excited that we are coming to the Indian police community this time with the broader message as to how they can save and how they can reach their financial goals. Thank you for watching the show.
As per the new tri-tariff order, you now have the power to choose and pay only for the channels you love. To keep watching your favorite shows on ET Now, call your cable or DTH operator and get the Times movies and news pack now.
The Showstoppers, the Jaw Droppers, the Movers and Shakers,
These are some of the hard facts.
the Power Players, all the blockbusters, all the hard hitters in one power punch.
That's awesome.
Complete your TV viewing experience with the best of Hollywood entertainment and news. Get the Times movies and news pack at just 13 rupees. Ask your cable or DTH provider now.
Partnered by Times Influence.